Get on board, get on track, get to where you're going. And now, your EduTrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your EduTrainer and coach for our EduTrainment workshops and our entry-level introduction into life insurance. Today and all this week, we're doing our introduction into variable universal life. And we want to make sure that you remember, always go out first before you take this class, take all the other classes that have preceded this. And if you haven't downloaded the LBL software, the Lincoln Benefit Life software, I need you to go out to their site to download the Eclipse illustration software at www.lblsales.com/ETW. That's www.lblsales.com/ETW. As soon as you come on, go ahead and run installer, download it so that you can go page by page with us. We think this software is the easiest tutorial to use in the industry. The software issues are really just easy to understand, and I think you'll get it, and we're going to be using it sometime this week, probably Wednesday and Thursday. Now, I also want to show you something from our sponsor, Lincoln Benefit, an Allstate company. They have a really great policy review materials that are out on their website. You can see it, it's trailing at the bottom of our screen. And in that, you're going to see some of the things that I really like, which is I love this Facts of Your Life booklet. I've been talking about it. It's a great data harvesting book. It comes either in electronic form or a hard copy. I totally say go out and get it because it's really, really a fine piece and it'll help you organize. There's stuff in that book that I never considered in my life. And another issue that I really like on this is it actually has a life insurance review. So you can kind of go through a life insurance review, see if you want to help the client out with their existing contracts so that you compare. And lastly, they have prospecting letters and prospecting postcards. Now remember, these are already done for you. If you want to change some of the language out of it, you're going to have to get your compliance officer to say it's okay if you're FINRA licensed. And remember, these pieces are really good for entry-level campaigns, marketing campaigns. We highly recommend them. And remember, if you forget, boy, did I miss a show, you can always hop out on our site, www.brokersalliance.com. As soon as you come to our website, you'll see our on-demand videos and all our shows for the Business Insurance Zone, our daily talk show on the internet, as well as our EduTrainment workshops. They're all out there. And remember, you can order the life insurance manual as well as our vocabulary sheet right at thebiz at brokersalliance.com. That's thebiz, THEBIZ at brokersalliance.com, and we'll send you the life manual and the vocabulary. We really recommend the vocabulary. Always be open during our class in case I use a word or a statement. Can you say, what did Steve mean by that? Well, I probably already spoke about it in a previous class, but the vocabulary words are right there for you and it'll really help your learning experience. Now, what I want to do today, we're talking about variable life. And when we talk about variable universal life, I want to go out to our whiteboard and I want to do the first couple things. I want to walk through this, and this is a very important issue. And that's why I want to really bring up to you that variable universal life is a security. It's a security. And because it's a security, you have to have a FINRA license, Series 6, and whatever state you're in, they're going to ask you for the blue sky as well. You'll need to have your Series 6 and your Series 63. Most states require licensing in all variable products. So you're going to have to check each state. So if you have, like we're out of Arizona, if I have my Arizona license and I want to sell something in California, I also have to be life insurance licensed and I also have to be security licensed. So every state that you want to do business with, you're going to need to make sure that you're licensed, not only life insurance licensed, but you're going to have to be security licensed in that state to do business. Another thing is you have to have a broker-dealer. You cannot sell variable products by yourself. You need to have a broker-dealer. And we have one, just I hate to be so mercenary in my class, but we use a broker-dealer that does not require us to submit our tweets, blogs, and articles on their non-FINRA communication. So what's really exciting is they allow you to go ahead and use them as your broker-dealer for your variable life and variable annuities, or maybe your mutual funds, depending upon how you're licensed. And they allow this, and what's really good is they don't take a haircut on your product on your non-FINRA products, so you don't have to worry about that. And if you ever want to leave their broker-dealer, your clients are your clients, and you can walk without a hassle. I really like that. So you need to have a broker-dealer. Another thing you need to do is remember, certain carriers actually distribute their VUL products direct to BDs, but most of the distribution is coming through people like us. So your BD could either be going direct with a carrier, which I think is the minority now. Most of them are now distributing through people like us who are actually independent marketing organizations. We're independent IMOs, and most of the distribution. And remember, your IMO also has to have some security license to be able to sell this to you as a producer who is also FINRA licensed. So remember, there's some requirements here, and the reason I'm going through it is because it's really important to make sure that we're doing all the things we need to do. So variable UL is a security. You must have a FINRA license, Series 6 and 63. If you do business in another state, you not only have to be life licensed, but you have to be FINRA licensed in that, at least minimum Series 6. You have to run this through a broker-dealer. The broker-dealer is getting the carrier contracts, the life insurance contracts, either direct from the carrier, but most of the time it's going through an IMO. Now, let's go to the next thing, and this is an interesting thing because I want to make sure we understand this. When we're talking about VUL, Variable Universal Life, we're talking about risk. Unlike indexed, which we're going to be talking about next week, you could lose the entire amount. And what you have to do is determine through a risk tolerance profile of your client, which again, we have those documents. And if you say, Steve, send me that risk profile, we'll send it to you. Just write me thebiz at brokersalliance.com. That's THEBIZ at brokersalliance.com. And I'll send you this so that you can kind of weigh out where your client's risk tolerance is. So there's a risk and reward issue. If I can lose it all, that's kind of bad. So I want to be able to assure that my asset allocation model is going to fit my risk profile. And before sometimes I can even get into risk and reward and asset modeling and seeing what my risk profile is, I need to think about, is this suitable for the client in the first place? So client suitability is a big item. Now, let's just walk through some of these concepts. I might be willing to take maybe risk 10 to 15% of my income for maybe an 8% rate of return or a 10% rate of return. If I want a greater rate of return, I may have to position my separate sub-accounts. And now we're looking at a whole nother thing of my asset allocation. Separate sub-accounts are not mutual funds. Now, they may look like mutual funds. The manager for a mutual fund may actually have its counterpart in separate sub-accounts, but they're really not mutual funds. So when I'm looking at sub-accounts, separate sub-accounts inside of VUL, I'm going to look at how much does it cost, what's the risk profile, and I could go out, and sometimes there's people like Morningstar who actually weigh this out for me and give me a beta risk, a risk of what I could be losing. And so I want to be able to look at that and try to match up my client suitability and my profiling, my asset profiling, so that my risk and reward matches up. Life insurance is already a long haul item. For variable life, for whether it's indemnification or it's income scenario, I want to make sure that I have the right proper model or asset allocation. Usually, illustrations are actually crafted or designed with a weighted average. They've already taken everything they sell inside the fund, inside their policy, all the access of these separate accounts, and they put like 1%, sometimes even a little less, teeny bit more. And what they do is they asset allocate all that as a weighted average to kind of give you an average expense. Every time I've seen a weighted average, it can be anywhere between 67 basis points cost all the way up to 90 basis points cost on a weighted average. Now, some will be higher, some will be lower. It depends upon if you're going to customize it or you're going to use the weighted average. That'll be your selection, your idea. I just want to look at those costs. I want to look at their risk, and I want to know what the price tag is. Because remember, for example, I could get a good S&P 500 fund inside some of these contracts for 20 basis points. That's pretty cheap. Some of them are over 115 basis points in their growth accounts and some of their income accounts, and I think you need to look at that. Is that risk and cost really something that you really think is really a good deal or not? That's why some people really punt and stay in indexing, because they believe between 6 and 7% rate of return is a pretty good rate of return without any subject of your principal being lost. We'll get into all that next week on indexing. But when I'm looking at variable, here's what I do get, and if I have that S&P account, at least I get the dividend participation. Now, could I lose my entire amount in the market? It's all exposed. I could lose every dime of it. So I really want to make sure that I have punt positions to at least get to money market funds in these accounts, that I can have switching options, that I can move it. And remember, unless your registered rep tells you that he's going to actually manage it, or she's actively going to manage this, you should always tell the client, heads up, here is the 1-800 number. Here's how you can push your funds to a money market account while you're waiting for the market to calm down. If you have any inclination that you can't take on risk, this is not what you should be doing. Now remember, interesting to note that many wealthy Americans, people who are very opulent, really like VUL, and one of the reasons is they're exposed to the market. They understand that. They've already been playing with it. They are suitable. They have plenty of cash on hand. They've passed all those risk-reward profilings, and they like, the biggest aspect of this is tax advantaged. If they're doing it for indemnification, the death benefit actually could go, depending upon the scenario, could go free to their heirs. But a lot of these more what I would call wealthy or affluent clients are actually using VUL as a tax advantage play. Once I've used my qualified plans, people are out in the market buying and selling mutual funds and individual stocks and bonds. Sometimes they like to look at an area where it's already prepackaged and I have tax advantages. The question is the expense loads in these policies greater than the tax advantages? And depending upon how you construct and design it, it can be very, very good for the client. If it's not done right, it'll be one of the most expensive funds or expensive investments he's ever done. You have to remember that if the word is, I'm doing this for income, and I bought it because it has tax advantages, then I need to look at make sure I modify or design my death benefit structure and suppress the death benefit purchase as low as I can under the insurance regs of DEFRA, TEFRA, and TAMRA. I just want to make sure that I'm always doing it. They say DEFRA and TEFRA and TAMRA, Steve, what's that? If you go back to the beginning of our class, which we recommend, I talk about some of these ideas, basic concepts, and we'll get into that a little bit more during the week. So I'm looking at VUL, looking for risk and reward. I'm looking for the asset model and how I profile my client. Is it suitable for the client? Can they take on the risk? Are they conditioned to doing this? Do I understand separate sub-accounts? Am I going to let somebody else manage it, or am I going to customize it for my client? Am I qualified to actually make that asset allocation call? And if I feel that way, sometimes I say, listen, if you're not going to manage this, actively manage this, and you're not going to stay involved with your client, and I mean involved, looking at this just like you do outside funds, then maybe you should start looking at indexing because it's a lot easier to handle. Or if you're going to buy a fund like this, you just say, the only reason I don't do index universal life is because I can't participate in the actual dividends, and I have caps and participation restrictions, and sometimes I don't like that. This is not restricted. You do participate in dividends, but remember, you could lose it all, whereas in the indexing, you would have the preservation of principal. The only expense load you'd have there is your actual expenses in the policy. We're going to be talking about all these things. The price tag for separate accounts, the actual risk and reward model, is that a good model? And more than that, we're going to be looking at the expense loads of these contracts. Is it more expensive to be into a VUL, variable universal life, than it is an index universal life? Believe me, it's company to company, carrier to carrier comparisons. I cannot make a blanket statement. I actually have to weigh that out and see which one is the better way to go. So we're introducing you into variable universal life today because we think that there might be a play as things rotate. We have cycles and product cycles. We believe variable has been sitting on the sidelines because of the punitive market we've been in since 2008. But I think people are now starting to creep back into the market. I think they're getting a little bit more relaxed about it, and they may be looking for tax advantages and a way to package a product so that they can be involved in the market. And the market, again, has access to equities as well as more conservative bond portfolios. You might want to look at this as another way of selling an investment that has tax advantage guarantees. That's variable universal life.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.